Hi and good morning from Hamburg. This is your daily dose of insights powered by Container Exchange. My name is Christian and we'll use the next 2 to 3 minutes to talk about what's moving container markets today and stuff we just find plain interesting. First off, Lunar New Year was yesterday, so welcome to the Year of the Rabbit. Prior to the holidays, we saw China slowing down significantly, also driven by its current wave of COVID infections. I've seen figures of more than 1 billion people infected, so this is pretty crazy. Key question in the market today is how fast China will open up after the holidays, and of course, what this means for container traffic ex-China. Based on the data we've seen, we expect the opening to be rather slow, especially on the big east-west trades, meaning Trans-Pacific and China to Europe. Together with continuously high capacity on those stretches, we expect further decreases in container freight rates. Having said that, smaller regional trades should be better off and rebound much faster. Secondly, talking of regional trades, this takes us to our second item of today. Something we find very, very interesting is the degree of increased capacity deployment by the top 20 container liners away from the big east-west trades that were so profitable during COVID towards intra-regional trades such as intra-Asia and Asia-Middle East IC. This is part to a longer-lasting trend that sees container volumes stable or even slightly growing on a global basis, but with significant regional differences. Trans-Pacific, according to latest CTS trade statistics, was down 25% November to November, while Asia to Middle East ISC was up 5 to 6%. For you container traders out there, this means that you should focus on building new business relationships into those growth markets, hence diversifying your trading base. Lastly, something that caught my eye on xChange Insights, and let me just share my screen here. Something that caught my eyes is here in xChange Insights. We're looking at the price development of 40-foot high cube brand new units in China and the US. And we see three key things here. First off, here in late 2021 and beginning of 2022, we still see that massive price differential, that massive price delta between China and the US, with China being significantly more expensive than the US. This requires significant major high pickup charges to be paid by the user to the supplier to make profitable buy, repo, sell cases possible. Then we see these lines converging towards Q3 last year, which created a lot of uncertainty in the market and hindered traders to adjust their pickup charge expectations. And now we actually see this gap widening, but inversely. So we suddenly see the US being more expensive than China, meaning that actually profitable buy, repo, sell cases are possible even without crazy pickup charge expectations by the seller or the trader. Very, very keen to see how that plays out over the next 6 months or so. Now, this was it from xChange Insights. If you want more insights and analysis, please go to containerexchange.com, log into Insights, and feel free to ask questions anytime. Have a profitable day, everybody.